try and, create one of those shock and awe sell-offs that turns into a 2 or 3 month decline in gold and silver. I mean, it gets stopped quickly. I mean, look at the latest one. I mean, gold's tested, 2,500 twice now this week, yesterday and today, and bounced off it both times. And when they tried to get silver below 27 and keep it below 28, I want to say about a month ago, maybe 6 weeks ago, I forget. Because I remember I saw at the time, I think it was the September silver future, and it dropped down below 27. That silver's going to go a lot higher. For this fiscal year, they're going to produce 7 million ounces.
Recent movements in the gold and silver markets show there was a significant sell-off in gold and silver, leading to a 2 to 3 month decline. However, this drop was short-lived, with gold bouncing back after testing $2,200 twice recently and silver holding above $27 despite attempts to push it lower. Silver, in particular, will rise substantially this fiscal year, given that production is expected to reach 7 million ounces. Dave Kranzler, a financial analyst and fund manager known for his expertise in precious metals, mining stocks, and macroeconomic trends, explains as the market approached a bubble burst, banks, particularly J.P. Morgan, struggled to syndicate the debt they had underwritten. They ended up holding a lot of distressed, leveraged debt. Hedge funds purchased this debt and structured over-the-counter derivatives around it, adding another layer of risk. This situation could lead to massive counterparty defaults, similar to what happened in 2008, unless the Federal Reserve finds a way to manage the liquidity issues before they escalate. Changes in accounting rules have made it easier for banks to conceal risky assets, such as OTC derivatives and credit default swaps. They can now net these positions with offsetting counterparties, making them appear less significant in financial reports. This relies on the assumption that all counterparties are stable, which is not always the case. This situation underscores the importance of considering alternative assets like gold. There are concerns that banks, particularly the Federal Reserve, are obscuring details about their gold holdings. There's skepticism about whether the Fed still legally owns the gold it holds for the U.S. Treasury. Despite attempts by figures like Ron Paul to push for an independent audit of the Fed's gold reserves, these efforts have been consistently blocked, partly due to heavy lobbying by the Fed, including hiring high-profile lobbyists. The Fed also avoids transparency through Freedom of Information Act exemptions. Gaining clarity on these gold holdings would likely require a federal court order, which seems unlikely. Let's dive into the video for more insights. If you enjoy the content, don't forget to give us a thumbs up and subscribe to our channel for the latest updates.
As toward the end of before the bubble kind of burst, the banks started having trouble syndicating the debt they were underwriting. So the banks have been, especially J.P. Morgan, they've been left holding a lot of this leveraged debt, leveraged transaction debt, and it's going distressed also. And again, that's the type of thing where they'll underwrite the debt, hedge funds will buy it, and then they'll structure OTC derivatives around the debt. So there's that aspect too. And so at some point, and I don't know when, and maybe the Fed figured out how to liquefy it before it actually happens again. But at some point, I think you're going to see massive counterparty defaults going on. And that's basically what happened in 2008. They changed the accounting. So what they did is they made it easier for banks to hide this stuff off their balance sheet, and they allowed them to use netting. So the banks can say, oh, well, yeah, we're long this OTC derivative, this credit default swap, but we have, counterparties that offset it over here. And they net that out. And so, even if any specific bank sitting on $1 trillion worth of notional derivatives, it shows up in the footnotes netted out to being not very significant. And of course, the key assumption there is that all counterparties are sound, which you can't make that assumption. The banks intentionally are, blowing smoke around what they're doing in the gold market, particularly the Fed. I mean, I think, you've studied the arguments and seen the information and the analysis probably for longer than I have. It's not even, no one's even sure if the Fed still possesses physically legal title to the gold that it holds on behalf of the U.S. Treasury. And if you remember, when Ron Paul, he was a bulldog about trying to pass legislation that would require an independent third-party audit of the Fed, which hasn't been done since Eisenhower was in office. And Barney Frank, who was the chairman of the House Banking and Finance Committee, or whatever they called it, or call it now, he would block that bill from getting out of committee every time it came up, every single time. And the Fed spent millions in Congress lobbying against it. In fact, they had hired, and she was the head lobbyist for Enron. So I mean, it tells you these guys know that there's issues with what's going on with the gold that's being held by the Fed, and they don't want anyone to know about it.
I mean, it's ludicrous.
And they also rebuff every Freedom of Information Act because they're not held accountable by the Freedom of Information Act. So the only way you're going to get them to open their kimono on what's going on with gold is to get a federal judge to compel them, and that's never going to happen.
Dave Kranzler explains, despite skepticism, there are strong motives for banks and central banks to manipulate gold and silver prices. The Federal Reserve is believed to be particularly active in this manipulation. Market movements, such as sharp sell-offs, often appear orchestrated, with banks leveraging their control over trading systems to trigger stop-loss orders from hedge funds and commodity trading advisors. By dumping large amounts of paper contracts, banks can cause significant price declines, exploiting key price points and creating sharp sell-offs. Meanwhile, if the reverse repo facility is drained, it could lead to significant issues, especially since major foreign buyers, including Japan, have stopped purchasing U.S. treasuries. This situation might force the Federal Reserve to start printing money again. While cutting rates is intended to stimulate economic activity and potentially increase long-term rates, the market is heavily intervened, making predictions uncertain. Lower rates could deter foreign investment in treasuries due to reduced returns and a weaker dollar, impacting the value of their holdings in their own currencies. Although smaller mining stocks are often overlooked compared to large-cap names, leading to market inefficiencies, junior mining stocks like Cabral Resources in Brazil can offer significant upside but face risks such as exploration and permitting. Despite political risk perceptions, experienced management and strong financing make these undervalued opportunities, though they remain high risk until production starts. However, mining stocks, including large-cap ones, are currently very cheap relative to the S&P 500, nearing levels not seen since the early 2000s. In my view, they represent one of the few traditional value sectors left in the stock market. Let's dive into the interview.
A lot of people still don't believe that gold and silver are manipulated, even though, there's every motive for banks and central banks to manipulate it. And as you pointed out, it's probably really only the Fed now that's fighting the prices. But that's what drives, when you look at, like I look at a 15-minute chart that goes overnight all day long. And when you see those fishing line sell-offs, that's triggered by the banks because they know where the hedge funds and the CTAs have their sell stops set because the banks run the COMEX computers and the settlement system. So, they know the key price points where if they can dump enough paper on the market and trigger the stop, it'll trigger an avalanche of paper selling from the hedge funds and CTAs. And that's what causes those sharp sell-offs. I think there's going to be issues when that reverse repo facility completely drains. And I mean, there might be issues in the next 6 to 9 months because most of our large foreign financiers aren't buying treasuries anymore. I think even Japan has stopped, which is shocking to me. But that's the $64,000 question. How are they? And that's why I think at some point the Fed's going to have to start overtly printing money again. Yeah, because certainly cutting rates, although a lot of people think the long end will move higher in rates. Because in theory, cutting rates stimulates economic activity, which then re-stimulates inflation. So rates go up on the long end. I don't know. I mean, look at mining stocks. They look at the larger cap names, Newmont, Barrick, Agnico Eagle. And so these things are largely ignored, except for, a small population of freaks like me who like to look at these things. And the market is extremely inefficient in terms of understanding, how to look at them and how to value them. And to be sure, they are options, but they're stock options, they're equity options on a project that don't have an expiration unless the project turns out to be a dud. So, that's kind of the trick, is to try and figure out which projects are going to be duds. And another thing that people, I think, get put off when when you talk to them about Cabral, is it's in Brazil, because they think, South America, political risk. Well, Brazil is probably one of the better jurisdictions for mining in the world. And I mean, Cabral already has what they call a trial mine permit, and that's what they're working on building. And the market just doesn't understand that. They don't see that. So the junior project development stocks that have valid projects and have good sources of financing and are run by experienced and accomplished CEOs and geologists, they're wildly undervalued relative to their potential upside. And again, they're just, until they actually get a mine built and operating, they're still options, because there's risk at every point of the way, from exploration risk, permitting risk, financing risk. You gotta be meticulous about, there's construction risk, execution risk of constructing the mine and getting it up and running. So until it's actually producing, it's a stock option, but they're extremely undervalued stock options if you find ones with worthy projects. The mining stocks, and including the large cap mining stocks, are about as cheap relative to the S&P 500 as they've been. They're not quite as cheap as they were in 2000, 2001, but they're almost back to that level. And in my opinion, it's probably one of the only what would be considered a traditional value sector in the stock market.
The current undervaluation of mining stocks and potential market manipulations in gold and silver highlight intriguing investment opportunities and risks. Monitoring these developments is crucial for making informed investment decisions. Do you believe the Federal Reserve will have to intervene more aggressively to manage market stability? How do you see the long-term prospects for smaller mining stocks amid these market conditions? Share your thoughts in the comments below. We'd love to hear from you. If you found this video useful, don't forget to give it a thumbs up and subscribe for more content. Thanks for being a part of our journey.